Welcome to a new week here on the Retirement Quick Tips podcast. I'm your host, Ashley Micciche. This week on the podcast, I'm looking at private equity and cryptocurrencies as investment options in your 401k. Is this a big opportunity or hard pass? Now, on August 7th, 2025, President Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. This executive order paves the way for allowing 401k plans to include alternative investments like cryptocurrency and private investments in 401k plans. Now, private investments is a pretty broad umbrella category. It would include things like private equity, hedge funds, if you think like venture capital. It could also include different types of debt or credit type investments. And it's a very, very broad category of alternative funds. Now, historically, these types of investments are only available to wealthier people, not because people who aren't wealthy or middle class or lower income Americans shouldn't have these, but the risk and the highly illiquid nature of these investments make them something that most people simply can't afford to invest in because you could lose everything in these investments. And they're very risky, highly illiquid, and actually not very well regulated either. So it would be easy for people to get swindled in these types of investments and lose everything. And so, for good reason, they've been restricted pretty heavily from everyday Americans being able to invest in them. But not so anymore, or at least that's what seems to be moving in that direction. It really begs the question now that this executive order has paved the way for these to be included in 401k plans. Is this a good idea for investors? Is this something you should consider for your own retirement? These have, like I said, these have a track record. They can be very illiquid. They're higher risk. They also carry significantly higher fees in most cases, especially compared to the low cost investments that are in most 401k plans today. And their complexity can create problems and all kinds of risks for investors if your plan trustee, 401k plan provider eventually chooses to add these types of investments to the plan menu and make them available. So I want to explore this a little bit more because you might see these options popping up in your 401k plan as an option that you can include and invest in alongside the target date fund or the stock fund or bond fund or stable value fund. You might soon see a private equity fund. And we want to make the right decisions, weigh the potential benefits and risks so that you're making prudent investment decisions in your 401k plan. All right, so before I dive into that a little bit further, if you're new to the podcast, a little bit about me. I'm a financial advisor and co-owner of True North Retirement Advisors, a fee-only financial advisory practice managing over $450 million in client assets. For the last 18 years, I've helped my clients retire with confidence. And on this podcast, I take complex retirement questions and I turn them into clear answers. So you can spend less time stressing about money and more time living and hopefully enjoying your retirement, whether that's right now or years into the future. Also, I want to say I am exploring some different formats for the show. I normally do a daily shorter episode. And so I would break a topic like this into several episodes and publish daily throughout the week. But this week, I'm just publishing one episode rather than the usual daily episode. So if you know someone who would be interested in this week's topic, please share the show. Be sure to subscribe and follow wherever you're listening. And if you're listening to this podcast on an Alexa device, that tops out at 10 minutes. So be sure to check me out on the other podcast platforms, Spotify, YouTube, Apple, pretty much everywhere. All right, so let's dive in. Now, in theory, having private investments, cryptocurrency, private equity, hedge funds, all that stuff, more options, it sounds great. More equals better. Investors already have pretty limited choices in their 401k plans. Usually it's a set menu available to you. Now, some of you in your 401k, you might have a long list of investment options. And that's actually a problem because research shows that the more investment options you have, the less likely people are to actually choose anything. It's like a paralysis by analysis. It's like, I see 60 different options here. I don't know what to pick. I'll just deal with this later. And then they end up not signing up for the 401k plan. So, a good 401k plan that's well constructed should only have maybe 10, at most 20 different options available. Right off the bat, we have a problem because if you're going to include private investments or cryptocurrency funds, you're going to either have to expand the menu, which leads to more choice and perhaps more paralysis, or you're going to have to boot out a different fund and maybe a better quality, better long term investment. The other issue I have is that for those who really want to access private equity or cryptocurrency, you don't need a 401k plan to do that. You can already access those. A lot of 401k plans have brokerage windows where you can invest in these options already, or just use an outside account. If you are in a position where you should be risking your money and investing in something that's going to provide maybe a higher return, maybe we'll get to that in a minute, but higher risk, then you should have other outside accounts. The danger here is that 401ks are pretty self-regulated. So like no financial advisor, unless you're working with someone who is giving you guidance and individualized support in selecting the menu of funds, most 401k investors are completely on their own. So that is a problem because you could be investing in something like this for years. You could put all of your 401k into one fund and it can end up blowing up. And that is a big, big problem. There's also a lot of risks associated with this. So, one of them, I think, is if you have this crypto or private equity fund in your 401k plan menu, a lot of employees, they assume that their employer, the plan trustee, they're endorsing that. They're putting their stamp of approval of this as a good option, and it may not be. Whoever is selecting the investment menu to be included in your plan may not be going through the rigors of evaluating these funds, may not be actually understanding even the underlying holdings or how these funds operate. How do they do in a good market? How do they do when things go sideways? What's the track record? How long has this fund been around? You would be surprised at how little scrutiny is paid to 401k menus in general, even by larger employers. A second problem here is that many participants pick whichever fund looks like the top performer. They're like, let me see this one. Ooh, I like the performance on that one. Let me put it in that one. Once you pick an investment in your 401k, a lot of times people hardly ever go back in. They don't log into their account. They don't check it. And now, when you're getting closer to retirement and it gets real, and you're like, I care more about this. But generally, people in their 20s, 30s, 40s, even into their 50s, they hardly log in. They hardly glance at their statement. As long as it's performing okay, they're not scrutinizing it. And that can be disastrous when you have volatile markets or an illiquid asset or something that's very risky and they don't understand the risk. They just picked the best performing one. The third problem here with risk is due diligence. Private equity requires very careful manager selection, diversification, understanding what those holdings are, and you have to have a tolerance for these illiquid funds. Also, cryptocurrency also comes with extreme volatility. And both of these types of funds can carry high fees, especially in the format that they would be available to investors, which is through mutual funds, which is likely how these are going to be cropping up in 401k plans. You're going to see more private equity type, private investment type funds that look a lot more like mutual funds, but they often carry high fees. And the average investor is just not going to do the due diligence on this. One of the reasons why I wanted to talk about this, I have a lot of experience working with 401k plans. I manage quite a few plans. I work with hundreds of different 401k participants, helping them navigate their own retirement decisions. And generally, what I'll do when I come in as an advisor, brand new to a plan, that already an existing plan, but I'm taking over as the advisor, sometimes I'll see specialized funds. So this could be like a technology fund, an energy fund, a gold fund, some very specific, very narrow fund in a certain industry or sector. And I typically recommend removing those funds because we want to help the employees build broad, diversified portfolios. So again, I want to cut down the menu so that there's maybe at most 15 different investment options, and you can hit pretty much all the broad categories with that menu. But we don't want to include those specialized funds because, like the crypto, like the private investments, the highs can be higher and the lows can be lower. And in the case of energy is a perfect example, or tech after the tech bubble burst, you have years where you could be underwater in these funds. And if you bet everything, especially in your 401k, or have a highly concentrated position in one of these specialized funds, it's a recipe for disaster. So we want to build diversified portfolios. Most 401k employees rarely are going to change their investments after they initially purchase that fund and invest in it. And so we want to make simple diversification the easy choice. And that's why target date funds work really well, because you literally can set it, forget it, hit that easy button, put it on autopilot, and it's broadly diversified and appropriately invested as long as you pick the right target date retirement year. The last thing I want to address here, as far as why I don't like it, why I think it's a hard pass. Do you see I'm going in this direction? I asked the question at the beginning, is it a big opportunity or hard pass? I'm going to go with hard pass. Private equity, as I've said, typically requires a higher income, higher net worth to qualify, and that is for a good reason. So allowing it inside a 401k effectively broadens that access to everyone, including those without the knowledge or the resources or the plan B to say, hey, if you put your 401k investment in this private investment or this crypto investment and it loses 50, 60, 70, 80% of its value, which is very possible. In fact, it's not just possible, it's happened loads of times with these investments. So if you don't understand the risks, and it's difficult to evaluate these funds, because honestly, I feel like you need a PhD in finance and economics to understand how most of these hedge funds, private equity, venture capital funds work. They're just very complicated. And you may have high potential returns, but so is the potential for significant loss. And I haven't really touched on this, but if you look broadly, yes, you can cherry pick funds and find ones that have provided spectacular returns. And I'm not arguing that. But a lot of these private investments, they don't work out. A ton of them do not work out. And so you can have great returns, but you can also have mediocre returns. And by and large, you're not really doing better in hedge funds or investing in private investments broadly. Now, again, you can cherry pick and point to situations where people have done exceptionally well. But in general, it has not paid off in terms of providing better returns, lower risk, compared to just investing in the US stock market and a diversified portfolio of plain vanilla stocks and bonds that don't carry the same risks. Now, before I close, I just want to talk about one other interesting point of view on this topic. I came across an article recently in Barron's. John Toomey, he's the CEO of HarborVest Partners, which, by the way, it's a private equity firm. So the guy has a vested interest in seeing this private investments come to fruition inside of 401k plans. So I just wanted to point that out. But he does make an interesting point. He says, quote, historically, private equity portfolios have been highly concentrated, with individual funds often holding only a dozen or two companies. That model may work for institutional investors with deep resources and long time horizons, but it isn't ideal for individual retirement savers. If we are going to integrate private investments into defined contributions, aka 401k plans, we need to rethink their structure, starting with built-in diversification. Now, he talks about also in this article, and I think argues a good point, which is that the overall stock market has become much more concentrated over the last couple of decades. If you look at the number of publicly traded companies today versus 20 years ago, it's significantly less. It's like 40% less. He does make an argument that, the stock market is highly concentrated And when you look at the lion's share of the returns in stocks going to the biggest tech companies, that is a big risk hiding in plain sight. I've talked about this quite often on the podcast. I am very worried about the fact that if you are just investing in like an S&P 500 index fund, you think you're well diversified because hey, there's 500 companies in there, but it's a market weight index, meaning that the largest companies make up a biggest percentage of the weight. And so you have only a handful of companies, like 10, that make up 35, 40% of the index the last time I checked. And that's only getting more problematic as the biggest, mostly tech names, continue to see their share prices go straight up, straight line up. And the assumption there is that the growth is going to continue forever. Well, guess what? If the company is growing at 20% a year and the economy is only growing at 2 or 3% a year, you just do some simple math and you can see that that doesn't work. Eventually, that company, the growth is going to slow down. The assumptions that are built into that is going to change. The stock prices are going to adjust and it's likely going to be painful. So, one interesting point that John Toomey makes in this article in Barron's is he says private markets offer ample opportunity for broad exposure. There are more than 297,000 companies backed by venture capital or private equity, compared with the roughly 2,500 companies represented in more broad-based indexes that you can invest in or that are available in your 401k plan. He goes on to say, we don't need to reinvent the wheel. The mutual fund investing framework already exists. Embracing mutual fund mindset in private markets can help investors manage volatility, limit exposure to any single company or fund, and potentially improve returns over the long term through broadly diversified investments in private markets. So again, he has a little bit of a personal stake in this, but I do think he makes a good point. And I do agree that as long as these private investments or the private funds that are included in 401ks are very broadly diversified, a small position in it could provide added diversification benefits and potentially enhance returns. But I just go back to some of the behavioral problems that I see where people will select funds, put everything in one fund. You introduce a highly concentrated position in these funds. And that's the kind of thing that I would like to be avoided, but I know is not going to be the case. Well, I think there are a lot of challenges to allowing private equity and some of these riskier investments in 401ks. That diversification element is compelling and worth considering, although I do remain a skeptic. All right, so in conclusion, the broad access, the choice, the ability to invest in these probably in the near-term future in the context of a 401k plan presents an interesting idea. However, I think the risks to the participants outweigh the benefits. What's wrong with building a plain vanilla diversified portfolio? And if you're concerned about the risks in the overall stock market, it's not a difficult problem to solve. You just can't have all of your stock market holdings concentrated in the S&P 500 index where a lot of the concentrations exist. If you invest in value stocks, if you invest in high quality dividend paying stocks, you achieve that diversification benefit. And most of those types of funds are also available inside of a 401k plan. So for investors who want exposure to private equity, private investments, hedge funds, crypto, that may be coming soon. However, these already exist, and there are other paths outside of the 401k structure. You can go down that path. You don't need it available in the 401k. And I would recommend that route, working closely with a financial advisor, someone who can help you truly understand the trade-offs of these funds, the risks and the benefits. All right, if you're enjoying the podcast, be sure to subscribe and follow. Leave a review and share the podcast with someone you know who's getting close to retirement. And if you're interested in learning more about working with me, you can check out my website, truenorthra.com. And you can actually book a free 15-minute call with me, clicking the link in the upper right-hand corner of the homepage. I absolutely love hearing from listeners. And if you have a question, a burning question about your retirement, I'm happy to chat, no strings attached. All right, next Monday, I'll be back with a new theme. Now, at this point, as I'm recording this episode, it hasn't happened yet, but the Fed will almost certainly, I think there's like a 91% chance that they're going to lower interest rates when they meet this week. In fact, by the time you're listening to this episode, depending on what day you're listening, maybe they already have. So, next week, we're going to talk about what that means for investors. If the Fed lowers interest rates, what does that mean for inflation, bonds, stocks, mortgage rates, your retirement? We're going to talk about all of that next week. I hope you have a blessed week. My name is Ashley Micciche, and this is the Retirement Quick Tips Podcast.